Good afternoon. This is Tom Alexander. It is Sunday, February 11th. It is about 5:25 p.m. Eastern Time in beautiful Charleston, South Carolina. This is going to be relatively short and sweet for two reasons. Number one, I've been traveling, but even if I had not been traveling, there's really not that much to say. The market is the U.S. stock indices are in very strong uptrends, and we have we're trading in new all-time highs in the NDX, the Dow, and the SPX. The Russell is starting to show some life. And it is, and I'll show this in just a minute when I show my screens, but it closed Friday at an important upper pivot level, and then there's another level above that would represent the high made back in late December. But a few things here, trying to predict the top of a momentum move like this it really can't be done. Somebody will do it, and they'll talk about it on Twitter, and they'll be talking about it for the next 6 years. But there's no objective, predictable way to tell when this market, as it is trading now, tops out. Now, I have been thinking for weeks now that the rate of change would slow down, and that really hasn't happened either. I do think that is a high probability event, that we will see the rate of change to the upside slow down, and we'll tend to get more 2-3 day balance areas at a minimum that include some retracement of 1 to 3%. Now, if you're expecting some sort of dramatic decline here, we could get an air pocket, 5% air pocket down at any time, but there's no way to know. I mean, this market is so extraordinarily big. So, that the smarter money is probably to see some sort of retracement, and then by the retracement, the momentum is too strong. And again, there's nothing above current levels except in the Russell, and I'll show that in just a minute. There's nothing above current levels that gives you a lean to be short. The better part of valor is to let the market retrace somewhat, and then you have a reasonable target that has been created by the actions of actual buyers and sellers themselves. So let's take a look at the charts for just a minute. And I realize everybody wants people with experience to tell them where the market's going to stop. The market's overbought. The market can't go up. Well, it can. Nobody knows where it's going to stop, and it can go a lot higher than it's gone. However, again, I don't think it's going to continue. I think the high probability event is that it was not going to continue with this rate of change. Now, what I have done here, this is, I've marked highs and lows. And what I have done, I went back for actually a few years. Now, I showed this last weekend as well, and marked the highs and the magnitude of the rallies. And we are in a rally of magnitude off of this October low. We're up 22.5%, and we're way overdue for some sort of retracement. Now, how much retracement we get, who knows? But we are certainly overdue for some sort of retracement. Now, are we looking for some sort of dramatic crash here? No, I emphatically no. If something is going to develop to the downside, it has to take out downside levels first. And the general guideline when the market is in a very strong trend, which we are certainly in, is that the previous day's low or the day before that, or the previous day or the second day back's low is taken out. Well, that would not be that much of a decline. You have this little gap here. So you could get some pushback from this 5,000 level very easily. But trying to predict that this is going to be a top of significance is absolutely an exercise in futility. You can see I've gone back and shown these rallies, these furious rallies that we've had over the past couple of years of similar magnitude, and they tend to top out around the area that we we're in now to one degree or another. Now, if this is the beginning, if we're in a bull market now that's going to run for another year or two, then, the retracement is the retracements, you really can't expect that much out of it. You're looking for maybe 2%, maybe 3%. You can see even back in 2023. And then I can go back farther. This was the bull run off of 2020, the 2020 low, which is interesting, but you can see we had these runs. This was 20%, then you had a 7% pullback. I'm not sure I'd even be looking for that. But I think you can see what is extraordinary about the current rally, particularly in the SPX, the NDX, and the Dow, is that the retracements have just been tiny, not even like this. I mean, this was a furious rally of 22%, but there were numerous two-sided periods of time where you had 1, 2, 3, 4% retracements. And that has occurred all the way, I mean, for the past few years. So that is what, to me, is most unique about the current rally, is the incredible lack of retracement along the way. The largest retracement we've had is a little over 2%. I think this is like 1%. So you could have a 1% or 2% retracement at any point in time. But if you're looking for more than that at this point in time, I'm not sure you're going to be fulfilled. Okay. Now let's look at the NDX real quickly. And, it mirrors the SPX. It's just basically vertical off of this October low. Now, the retracements in the NDX, we have had more retracement in the NDX. It tends to be more volatile anyway. So this was about 2.8%. This was 4%. This was, this is more in line with what you would typically see actually in the NDX. The SPX is the one that has had such little retracement. And then the Dow, sort of between the SPX and the NDX. But and then last but not least, the Russell. And the Russell now has caught some momentum. It's caught a bid here, and it's testing this pivot high. It closed right on top of it on Friday. This is a big level. This is the late December high, and the Russell just off the October low actually led the market higher. It had the greatest magnitude rally, almost 27%, and then it had a very deep retracement. Well, it looks like it's playing catch up now. Now, there are all sorts of potential scenarios here. We could have the NDX and the SPX, those 5 or 6 stocks, take a breather while the Russell catches up, all sorts of things. But I don't see anything looking at these charts, looking at the price momentum, that suggests some sort of Armageddon top is imminent. If we start taking out levels to the downside, that can be revisited. But if you're looking at price action, the price action is positive. Now, are we extended in all time frames? Certainly. We're extended in all time frames. But remember, if you're trying to sell this market, I would only do it on a very, very short-term basis, maybe day trading or something. But right now is not the time, in my opinion, to be aggressive trying to pick a top in this market. The next 5% move, in my mind, is a complete total coin flip. Now, as far as internals are concerned, and specifically NYSE breadth, it has not been particularly helpful because the market is so thin. The market is being driven by 5, 6, 7 stocks, the major indices, the SPX, the NDX, and the Dow. The Russell is a different story, obviously, but you can see we're making higher highs and higher lows. Each little minor leg, you just have this furious ramp. So we could be getting closer to at least a 1 or 2 day back and forth that includes a 1-2% decline. The 10-day moving average of NYSE advancing issues and the 5-day moving average of advancing issues are sort of curling up. But as I said, this is not particularly helpful now. You could look at this and say, oh, wow, look at that divergence, which is something I've been pointing out. However, it doesn't matter right now because, again, the market is being driven by a handful of stocks. So that's where we are. So you guys enjoy the Super Bowl. Those of you that are watching it, I will keep you updated, and I'll speak with you again soon.